So this session, we're going to dive deeper into the liquidity crisis in the rural banking or the community banking sector in the US. And Barney spoke quite a bit on it. And we want to draw some lessons from it, right? From an insider of Barney is a part of policy setting, okay, as a former chair of the US House Financial Services Committee and of course, the co-author of the Financial Reform Act. And you are also a director of Signature Bank, one of the banks that went under. It is regulated by the Financial Depository Insurance Corporation, and it's come out with a report on the causes of the failure. And it's got some points that are quite interesting. And one of which is management failure. Right? But it was also self-critical in terms of the role of regulators, right? It put a lot of the blame on the growth of Signature Bank's assets, especially in digital assets, deposits, and that management didn't fully understand the risk involved. Maybe as a start, we would like to get Barney's kind of view on the report itself. From this morning, we know that you don't quite agree in terms of the cost of it. Yeah.
Sure. It is true that we did not fully see the risk, but neither did the regulators. And in fact, they are a major reason why I didn't see a risk. We were a bank that was regulated primarily by the state of New York as well as the FDIC. In the United States, there are nationally chartered banks and state chartered banks. It was requested of them by the New York regulator. The New York regulator was the major actor here. And on February 15th, we met, the board of directors and the management, with the two regulators, the FDIC and the state of New York. And at that point, they gave no notice that we were in peril. As a matter of fact, directly to the contrary, the rating system for banks in the US is called the CAMEL system, CAMEL being an acronym, Capital Assets Management, Equity, and Liquidity. The highest is 1, 5 is terrible. We had always had a 2. Very few banks get a 1. So we had a 2 rating, and then on February 15th, they reaffirmed the 2 rating. So less than a month before we were shut down, the 2 regulators continued giving us the second highest rating with, as I said, no indication that there was a panic. What happened was, on a Friday afternoon, because Silicon Valley Bank failed, we were hit with an extraordinary rush of deposit withdrawals. And on Sunday, they decided to shut us down quite prematurely, in my judgment. At no point did they ever argue that we were insolvent or that we did not have sufficient capital and assets in general. What happened in America was a panic induced by the notion that there was something incurably toxic about the affiliation with crypto. Now, Silicon Valley Bank, which failed first, did have serious problems other than the affiliation with crypto, but technology has now migrated to the individual so that you can withdraw your deposit and redeposit them somewhere else with 2 pushes of the button, 7 days a week, 24 hours a day. So that's one problem. Our deposit insurance limit, over my objection, I'd want it to be higher, is $250,000. If you're a rich individual, fine, you can find other ways, money market funds, etc., to protect yourself. If you are a business with a payroll and with vendors to pay, there is no way, obviously, that you can deal with a $250,000 limit on your deposits. So I strongly believe, and I did before, but now we have this crisis to make the point, that we need to increase the deposit insurance limit for businesses. Secondly, we need to do some regulation of crypto. The fear of crypto went beyond any reality of damage that could come from crypto.
Could they be predictable?
Well,
exposure.
I suppose anything could be predictable. The clear fact is that the regulators did not predict it. Again, on the 15th of February, less than 1 month before they shut us down, they said we got the second highest rating. I was at that meeting. There was no statement that said you guys better be careful. So I suppose something could be predicted, but nobody did. And even if, given where we were, and here's where Signature is different than Silicon Valley. Silicon Valley had solvency problems. No one ever alleged that we had any solvency problems or any toxic assets. We just had the liquidity crisis. Now, theoretically, you can deal with a liquidity problem by greatly bulking up your assets, but you do that at the cost of your ability to function, to lend money. And given the enormous run on the bank, the only way to have prevented that from causing a serious problem would have been to have built up a great deal of sterile assets. But finally, to answer Gordian's question, yeah, there's a very simple thing we can do going forward. If our depositors, our uninsured depositors, those who had more than $250,000, were all businesses. We did a lot of business with commercial real estate, particularly, and I was very proud of this, affordable housing, multifamily housing. And it was necessary for them to have more than $250,000 in their accounts. If we had, what I hope we will now go forward with in America, a deposit insurance limit for transactional accounts, and my proposal would be, it's kind of a compromise, if a business can show, which is fairly easily done, that it has payroll requirements of paying vendors and other necessary ongoing business expenses for 2 months, that amount should be subject to deposit insurance. A very simple fix would be, and the FDIC has now proposed this, and when we passed the reform bill in 2010, we in the House wanted to do that. We ran into this, and here's our objection from some of the conservatives, because deposit insurance is a form of government activity. The argument is that if you increase deposit insurance, you will diminish a check on reckless banking activity, because the fear that depositors have that they will lose the uninsured portion of their deposits acts to make them a better monitor of the bank's practices. There was no problem with asset quality. We had an insolvency problem, and I make that point because we take credit. We solved that problem. The regulations that we adopted in 2010 prevented the bad asset problem. Banks have been and are still prohibited from making the kind of reckless loans or engaging in the other kinds of improper, imprudent lending activity. So we solved that problem.
Maybe one exception is that in times of abrupt and unexpected interest rises, holding fixed deposit assets is also an asset risk.
In many cases, the interest rates that you grant are adjustable and then go up. The only problem from the rise in interest rates that we saw, I remember only 3 banks failed. This was not a massive failure, and in fact, the system went on, the stock market went on, there was no macroeconomic negative consequence, and the only problem was the overconcentration in treasuries that were hurt, and that you could deal with. The other problem, though, about simply maintaining enough liquidity, had we maintained enough liquidity to sustain that degree of a run, we would have had to seriously curtail our lending.
Sure.
And I don't think it's good for the economy.
But also the profit, you would have been unprofitable or less profitable.
Yeah, but our profits are generated by constructive activity. I do not think it would have been healthy if we had cut down on the supply of affordable housing in New York City. One of our major activities was lending for affordable housing using various government programs. Yes, we set that up. That we may have, and I'll acknowledge this, in 2010, we thought we were doing that. We did empower the Federal Reserve to set up a facility to provide liquidity to solvent institutions. And if that had been put into effect on Friday, we would not have failed. If we had been allowed to open on Monday with that in effect, it would not have failed. There may be, and we do have to look at this, it may be that the triggering of the establishment of that facility needs to be made more flexible, so it can be anticipatory rather than after the fact.
Exactly, because what happens is that the government panics. In Switzerland, the government
Oh, absolutely.
over the weekend decided to essentially move that to UBS, nationalize that.
That deals not with the role of crypto and banks. That's the SEC protecting investors. And it is, and look, part of it, this is FTX, it was the perception that investors in crypto were not adequately protected that contributed greatly to the panic about crypto that generated the deposit withdrawals from our bank.
Precisely, I think, and that's the conclusion, is that if you can predict the future, what's the point of actually trying to predict the future? We simply don't know. But what we do know is that if we don't handle the customers or the public's expectation, we actually could unleash a beast that through different mediums could cause trouble to the banking system.
Yeah, I would sum it up this way, but it's something I learned as a candidate for 40 years, appealing to public opinion. Just because a substantial part of the public gets it wrong doesn't mean that they won't have an impact. You have to be as concerned about erroneous public opinion as you do about accurate public opinion.
I think that really summarizes that very well, because that is what happened in several cases. And in addition, I would like to say, of course, you can say that, is that governments tend to panic in crisis. They are not really very well equipped for crisis.
Well, right, and again, the only thing I would say, Gordian, is this, and you talked before about politicians. I do not think people fully understand how much influence the public has. The government is not independent of public opinion. And in the American system in particular, public error is very easily transmitted to official actions.
Very good. Well, thank you so very much. We always love to have you here, and you are a very loyal and regular guest, and your insights are extremely valuable. So please join me in giving a big hand, Barney Frank, former congressman, for his insights and for the time he spends here and for the long way he's coming here. So thank you very much, and hope to see you again soon.